Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
The chart that you should be looking at right now, this is EUU. So as I got into the financial management industry and investor education, brokerages, things like this, one of the things that I really saw missing when Forex trading started taking off in the early 2000s amongst individual traders was they had a very binary choice. Meaning that they could go long the Euro USD, the Euro versus the dollar, or they could be short. But there really wasn't any in between. So they were long or short, and they applied stop losses. And, equity traders, traders in the futures market, et cetera, have had a much broader range of products to be able to create a better blend for their trading strategies and their own risk objectives because they had access to products like options. So I've been very passionate about the introduction of the ISIS Forex options, FX options, since they first came out because it's finally kind of opening that up. Now, for those of you, I know that there are some of you already here in the audience who have some experience trading in the Forex, particularly in the spot Forex. So and that particular product is in a state of flux right now, and that there's a lot of changes coming down from the CFTC as far as leverage is concerned, and that's introduced some constraints in the way that traders have been operating in the Forex. And I think once again, this kind of is an opportunity for FX options to prove how valuable they can really be. So I'm pretty jazzed about the fact that they're available at this point. Now, what I'd like to do is to walk through a couple of concepts as to how might we use Fibonacci analysis to answer a couple of questions relative to making trades in the FX options market. And then I have a quick case study to kind of wrap up my point as to how would I do this kind of analysis today. If I were looking across the major currencies available, how would I how would I do a sample analysis today? So let's start out by looking at EUU. Now, EUU is essentially the euro versus the euro-dollar pair, if you will. And so if you were to, right now, EUU is priced at 1.35.1. I'm sorry, 135.1. If you were to move that decimal place over just two places, what that basically means is that it costs to buy 1 euro, it costs $1.35. So the fact that the EUU has been trending down lately, there's been actually a fair amount of dollar strength out there in the market. I think that to a certain extent, that's just related to the risk environment out there. I think a lot of traders are a little bit nervous about outstanding risk issues, and so when risk is going up in the market, the dollar does sometimes benefit from that because traders will look for safer assets denominated in dollars and look for even just to hold dollars. I think that's been kind of amplified by the fundamental factors that we're dealing with in the Eurozone, where we have some credit problems. So you've got some countries in the Eurozone dealing with creditworthiness issues. So Greece, Portugal, Ireland, et cetera, are all having some problems. And so that's bad for the euro, and once again, kind of good for the dollar comparatively. So that winds up being this downward trend, which means that the dollar is essentially strengthening against the euro, or the euro is falling in value over the last little while. But the question becomes, when we're trading Forex options, is, well, all right, so fine. I think the trend is overall negative on this particular currency pair. How do I determine where and when I might want to make a trade, especially if I'm looking at a short-term on a short-term basis? Well, Fibonacci's can be a really handy tool to be able to do that. And because options, if you're trading long options or a spread or something like that, oftentimes you have you already have a known maximum risk and a known maximum gain in advance. So it makes it really easy to plan. And being able to answer the where and when questions is helpful as we plan around things like expiration. So, if we were making very short-term trades today and maybe trading options that expire in March, well, we have, about 25 days or so before that expiration occurs. So we'd need to plan ahead a little bit. And I hope to be able to introduce a couple of ideas today in how would we do some of that planning. Okay, so right now the Euro USD is in a downtrend, and when I am talking about Fibonacci retracements, I'm usually talking about two things. So let's go back in time a little bit. I'm going to scroll a little bit back in time here. So we're just looking at what happened. We're going to look in the past for a couple of illustrations, and then we're going to do a little case study here at the end of the presentation into what's going on right now. How would we apply these same principles today? So EUU, I've just applied a kind of a traditional Fibonacci retracement. These are the lines you normally see. If you're not familiar with a Fibonacci retracement, it essentially is a tool that divides the trend into 3 or 4 layers. So in this case, I've identified the trend. I've anchored the trend line from the top of the decline in early December, very, very late November, to the middle of December. So that initial rundown, and then finally the market started to move back up again, and we've got our little trend segment here. So, and what the Fibonacci retracement tool does is it basically divides that trend into these little segments here that are based on the Fibonacci number series. They're essentially the ratio between sequential numbers in the Fibonacci number series. So everything from 23% of the way through the trend to 61% of the way through the trend. Each one of these lines becomes a candidate resistance level if we're measuring a bounce up. So our prior trend was down, so we're looking for these lines to kind of identify a resistance level on the bounce. And so each one of these becomes a candidate for that. So if we see the market pause at one of those levels and then begin to decline, we'd definitely want to pay attention to that. Now, sometimes, depending on the length of the prior trend, these lines can be pretty close together. So we want to watch out for that. If I'm using a daily chart, I like to see a trend that's fairly robust that I'm applying, or a trend segment rather, that's fairly robust that I'm applying a Fibonacci tool, because the smaller that trend is, let me show you. If I were to anchor this further up the trend, you can see these little subdivisions of the trend segment become tighter and tighter, and it would be much more difficult to tell the difference. So if when you're using Fibonacci analysis, that's always something that you want to make sure that you're paying attention to, and not using a trend segment that's too small and compressing your retracement lines. Okay, so now I'm going to actually come back to this example here on the euro, the EUU in this case, which is the FX option index that you can trade options on the euro-dollar currency pair. And we're going to look and see, well, okay, once we've identified, in this case, a potential resistance bounce that would indicate that we might have a renewal of the prior trend to the downside in this case, how do we start to manage? So we've answered a potential when question. So when do we enter the trade? What we want to be able to do is identify. We also want to identify the where. How far is this particular trade likely to go, so we can start to plan.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.